What happens when prices rise evenly is called inflation. What happens when only the things you cannot live without rise faster than everything else is something far more dangerous. The shift begins quietly. Food doesn't spike all at once. It inches higher trip by trip. Electricity doesn't double overnight. It ratchets upward through fuel surcharges, grid fees, and seasonal adjustments. Insurance doesn't announce a crisis, it sends a renewal notice with a number that no longer fits your budget. One increase can be absorbed. When they move together, the math collapses. Since 2019, the categories that define daily survival have risen at historic speed. Motor vehicle insurance is up over 56%. Electricity has climbed more than 40%. Meat, poultry, and fish are up nearly 38%. Food consumed away from home is up 35%. Rent is over 30% higher. Even bread is close to 30%. These are not discretionary purchases. These are non-negotiables. You cannot delay them, downgrade them meaningfully, or opt out. That is the trap. Economic theory assumes consumers respond to higher prices by switching behavior. Buy less steak. Drive less. Shop around. That logic collapses when inflation concentrates in necessities. You can't substitute away from electricity in winter. You can't comparison shop rent when vacancy rates are tight. You can't skip insurance when it's legally required. What looks flexible on a spreadsheet is rigid in real life. This is why spending patterns are no longer a reliable signal of strength. Households are not buying because they feel confident. They are buying because survival requires it. Essentials have become a captive market where demand remains even as affordability disappears. That disconnect is the core danger of the current cycle. The result is a distorted economy where headline inflation may cool, but lived inflation accelerates. Official CPI might show a mid-20% increase since 2019, yet the items that dominate monthly budgets have surged far beyond that. When half of a paycheck is consumed by housing, utilities, food, transportation, and insurance, a single category jumping 10 to 15% can break the entire system. This pressure compounds because essentials interact. Higher fuel costs raise food prices, higher insurance costs raise transportation and housing costs. Higher utility costs raise rent and manufacturing expenses. These aren't separate shocks, they stack. Each increase becomes the justification for the next. By the time prices reach consumers, the increase has already been layered 3 or 4 times upstream. What makes this phase different from previous inflation cycles is timing. These increases arrived after households already absorbed years of strain. Savings that cushioned earlier shocks are gone. Pandemic buffers are exhausted. Emergency funds have been drained. There is no slack left in the system. When necessities rise now, there is nothing left to cut except quality of life. This is where luxury and basics swap places. A stable power bill becomes a privilege. Reliable groceries become a budgeting event. Insurance becomes a gamble. Maintenance becomes optional until it becomes a crisis. The economy doesn't collapse all at once. It tightens. Quietly, relentlessly. And this pressure doesn't stay contained. When households devote more income to survival, everything else contracts. Discretionary spending weakens. Delayed purchases become permanent cancellations. Demand erosion spreads outward from the center, hollowing the economy from the inside. This is the foundation for what comes next. When necessities absorb income faster than wages can replace it, prices no longer reflect choice. They reflect coercion. And once an economy crosses that line, it stops behaving like a market and starts behaving like a pressure system. From here, the question is no longer why prices are high, but why they keep rising even as people are clearly running out of money. The modern economy is no longer driven by demand strength. It is driven by cost defense. Prices are rising not because consumers are buying more, but because producers are trying to survive a higher cost system without shrinking. The first force is financing. After years of cheap money, businesses are now operating with borrowing costs that are 2 to 3 times higher than they were just a few years ago. A company that refinanced debt at 3% in 2020 may now face rates above 7%. On a $100 million balance, that is an extra $4 million per year in interest alone. That money does not come from innovation. It comes from higher prices. Then come operating costs that never reverse. Commercial insurance premiums have surged by 30 to 50% across multiple sectors. Property insurance in some regions has doubled. Liability coverage has exploded. These are fixed costs. They don't respond to weaker demand, they demand payment every month regardless of sales volume. Energy compounds everything. Electricity is up more than 40% since 2019. Diesel prices remain structurally higher. Natural gas volatility feeds directly into manufacturing, logistics, food processing, and retail operations. Energy is embedded in every product. When energy resets higher, it lifts the entire price structure with it. Labor is not the villain here, but it is part of the stack. Even modest wage increases become permanent expenses. Once payroll rises, companies cannot roll it back without layoffs. To avoid that, they raise prices instead. This is not greed, it is survival math. What breaks the traditional model is market concentration. In many industries, competition is thin. When 4 or 5 firms control most of the supply, price discipline replaces price competition. No one wants to be the first to cut because cutting prices no longer restores volume enough to justify the loss. So prices hold, even as sales slow. This is where price floors emerge. Once a product is repriced to cover higher insurance, energy, labor, compliance, and financing, lowering it becomes impossible without operating at a loss. These floors lock inflation in place. Demand can weaken, traffic can fall, sales can stagnate, but prices do not retreat. Instead, pricing shifts sideways. Fees replace sticker prices. Surcharges appear quietly. Package sizes shrink. Subscriptions become mandatory. Services that were once bundled are unbundled and monetized separately. The number on the shelf stays stable while the real cost climbs. This is why price relief feels absent even when consumption slows. Businesses are no longer trying to grow. They are trying to maintain margin integrity in a hostile cost environment. Growth is optional, solvency is not. At the macro level, this creates a paradox. Weak demand normally destroys inflation, but when cost pressures dominate and competition is limited, inflation becomes sticky. The economy cools without prices cooling with it. That is the worst possible combination for households. And the system reinforces itself. Higher prices suppress demand, lower demand reduces volume. Lower volume raises per unit costs. Higher per unit costs justify higher prices. What looks like stubborn inflation is actually a self-feeding loop. This is why policy signals no longer match lived reality. Rate hikes can slow spending, but they also raise financing costs. That pressure gets passed forward. Monetary tightening meant to fight inflation can, in the short term, lock inflation in place. What emerges is a market that no longer clears through price discovery. It clears through exhaustion. People don't stop buying because prices fall. They stop buying because they can't go any further. When prices stop responding to demand and start responding to balance sheets, the way prices are set has to change. That is the bridge into the new pricing system. One designed not for transparency or competition, but for extraction without resistance. The old model relied on visible prices, a number on a shelf, a rate on a bill, a clear comparison between options. That model fails when consumers are already stretched, because visible price hikes trigger backlash. So the system evolved. Prices still rise, but they do so quietly, fragment by fragment. Algorithms sit at the center of this shift. Pricing is no longer static, it is adaptive. Software now adjusts prices based on location, timing, inventory levels, purchasing history, device type, and perceived willingness to pay. The same product can cost materially different amounts within miles, hours, or clicks of each other. Studies have shown digital price variation of 15 to 30% for identical goods, depending on user profile signals. This isn't inflation in the traditional sense. It's individualized repricing. Fees do the rest of the work. Instead of raising the base price, costs are broken apart and reassembled at checkout. Processing fees, convenience fees, delivery fees, regulatory recovery fees, energy surcharges. These additions rarely appear in headline prices, yet they account for a growing share of what people actually pay. A bill that once reflected a single service now contains a stack of microcharges, each justified, none optional. This fragmentation matters because it changes consumer psychology. People are less likely to resist a $3 fee than a $30 price hike, even though 10 fees accomplish the same outcome. That design is intentional. It spreads inflation across dozens of small-line items until the total becomes unavoidable but emotionally muted. Subscriptions lock the system in place. Services that were once discretionary or occasional are converted into recurring charges. A $12 monthly fee feels manageable. 12 of them quietly become $144 a year, multiplied across dozens of services. Cancellation friction ensures that even unused subscriptions continue extracting value. Inflation becomes automated. Package manipulation finishes the cycle. Prices appear stable while quantity shrinks. Weight, volume, coverage, and service duration are reduced. A product that cost $5 last year still costs $5 today, but delivers 10 to 20% less. This is price inflation disguised as consistency, and it bypasses most public scrutiny. None of this is accidental. These systems exist because traditional price increases hit a ceiling. Consumers are tapped out, so pricing shifted from blunt force to precision engineering. The goal is not to sell more units. It is to maximize revenue per user without triggering disengagement. The numbers confirm the intent. Companies that deploy advanced pricing analytics report margin improvements of 5 to 15% without proportional increases in volume. That gain does not come from efficiency alone. It comes from extracting more from each transaction. What makes this system dangerous is that it is invisible in aggregate data. Official inflation measures struggle to capture fees, shrinkage, personalization, and bundled charges. The economy appears calmer than it feels because the pain is distributed in ways that are hard to measure but impossible to avoid. And this system feeds back into itself. As costs rise upstream, businesses lean harder on algorithms to protect margins. As algorithms succeed, competitive pressure weakens. When competitors all adopt the same tools, prices stop competing and start coordinating, not through collusion, but through shared optimization logic. This is why price relief no longer arrives when demand weakens. The system doesn't wait for recovery. It recalibrates extraction to match stress tolerance. When people push back, prices don't fall, they hide. What began as cost defense has evolved into a permanent pricing architecture, one that assumes consumers will adapt, absorb, or disengage. And when disengagement finally happens, it doesn't show up as falling prices. It shows up as something far more destabilizing: households hitting the limit of what they can carry, and discovering that income was never designed to keep pace with a system built to outlearn them. Once prices become adaptive and hidden, wages lose the race before it even begins. That is where the collision happens. Not loudly, not suddenly, but relentlessly. Paychecks move in straight lines, prices now move in curves. Nominal wages have risen since 2019, but they have risen slowly, unevenly, and without regard for where the money actually goes. A 4% raise sounds positive until the expenses that cannot be avoided are rising at double that pace. When electricity climbs over 40%, insurance jumps 30 to 60%, rent moves past 30%, and food categories sit between 25 to 40%, wage growth stops functioning as progress. It becomes damage control. This is not a productivity problem. It is a timing problem. Wages adjust annually, if at all. Prices now adjust continuously. Algorithms reprice weekly. Fees appear monthly. Insurance resets in a single notice. A household can lose purchasing power faster than a paycheck can ever respond. That creates effective pay cuts, not theoretical ones, real ones. When take-home pay rises $2,500 a year but unavoidable costs rise $6,000, the result is not stagnation. It is regression. The paycheck arrives, but it reaches fewer destinations. Taxes and deductions amplify the gap. Gross wage growth is not the money that clears. Payroll taxes, healthcare premiums, retirement contributions, and benefit cost sharing eat first. A $1 raise does not translate to $1 of usable income. Meanwhile, prices hit the checking account directly without filters or delays. This is why wage statistics feel disconnected from lived reality. Averages hide the structure of expenses. Housing, utilities, food, transportation, and insurance now dominate monthly budgets. When over 60% of income is consumed by essentials, even strong percentage raises fail to restore balance. The margin for flexibility disappears. The collision worsens because pricing systems are now optimized against income ceilings. Companies know exactly how much households can tolerate before disengaging. Pricing is designed to extract just below that threshold. Wages are not competing against static prices. They are competing against adaptive ceilings that move faster than human negotiation ever could. This is also why job growth no longer guarantees relief. More income does not solve a system where costs scale automatically. Two earners do not double security when shared expenses rise faster than combined pay. Overtime does not restore stability when insurance premiums jump $300 to $600 per month in a single renewal cycle. The imbalance compounds over time. Each year that wages fail to close the gap, households lose ground permanently. Missed savings. Deferred maintenance. Reduced resilience. What starts as affordability stress turns into fragility. One bill becomes a trigger. One increase becomes destabilizing. And there is no reset mechanism. Prices do not roll back to meet wages. Wages are asked to chase a moving target that is designed never to slow down. This is why the pressure feels endless. There is no finish line where things catch up. The collision between wages and prices is not cyclical, it is structural. One side is fixed to human limits. The other is optimized beyond them. When income can no longer match the speed of extraction, households are forced to bridge the gap another way. Not by earning more, but by borrowing time. When income fails to keep pace, the system does not slow down, it substitutes. That substitution is debt, not as leverage, not as lifestyle, but as a structural replacement for missing pay. This is the point where the economy stops running on earnings and starts running on borrowed time. Credit was once used to smooth large purchases. Now it is used to stabilize monthly survival. Groceries, utilities, insurance premiums, fuel, medical bills, categories that used to be paid from income are increasingly paid with plastic, installments, or deferred balances. The shift is measurable. U.S. credit card balances have surged past $1.3 trillion, the highest level ever recorded. Average interest rates now exceed 20%, with some accounts charging 25 to 30%. This is not discretionary borrowing, it is gap financing. Buy now, pay later programs have expanded rapidly, not because they offer convenience, but because they allow households to divide necessity costs into smaller psychological units. A $400 bill becomes four $100 payments. The total does not change, only the illusion of manageability does. Missed payments do not reduce prices. They compound stress through fees and penalties. What makes this phase uniquely dangerous is duration. Short-term credit assumes recovery, but when prices remain elevated and wages lag structurally, balances do not clear. They roll. Minimum payments replace payoff plans. Interest becomes the new expense category, one that produces nothing but drag. Debt service now competes directly with essentials. At a 22% interest rate, a $10,000 balance generates over $2,200 per year in interest alone. That is money extracted without delivering food, shelter, or security. It simply sustains the borrowing loop. This transforms the household balance sheets. Credit limits are treated like income extensions. Emergency funds are replaced by revolving accounts. Financial resilience disappears quietly long before default ever occurs. On paper, the system looks stable. In reality, it is hollowing out. The danger escalates because debt masks distress. Spending continues, so demand appears intact. Bills get paid, so delinquency lags. Markets see consumption and assume health, but the fuel source has changed. When credit replaces income, every month pulls demand forward from the future. Eventually, the future runs out. This is why rate sensitivity is now extreme. Each additional percentage point in interest does not just cool borrowing, it destabilizes households already stretched thin. A single rate hike can push minimum payments beyond reach. Once that happens, the unwind is fast. There is no soft landing from survival debt. When borrowing is used to fund essentials, there is nothing left to cut. Defaults do not free cash, they destroy access. The system moves from silent strain to visible fracture, and this pressure does not remain personal. Rising delinquencies force lenders to tighten credit. Tighter credit removes the last buffer households had. Consumption then falls sharply, not because prices fell, but because borrowing capacity collapsed. This is the delayed shock embedded in the current system. Debt keeps the economy moving long after affordability is gone, but it does so at the cost of future stability. Once credit can no longer substitute for income, participation becomes optional for some and impossible for others. When debt replaces income, stress stays invisible until it doesn't. The moment borrowing reaches its limit, affordability stops being a personal problem and becomes a collective force. This is where economics turns social. Participation in everyday life depends on prices staying within reach. When that condition breaks, behavior changes first. People delay, downgrade, withdraw. They stop repairing, stop replacing, stop planning. These are not acts of protest, they are acts of exhaustion. But when millions make the same adjustments at once, the effect is political, whether anyone intends it or not. Affordability pressure concentrates anger because it is experienced daily. Elections happen occasionally. Prices happen every morning. A gallon of gas near $4, a power bill crossing $300, insurance premiums jumping $200 to $500 a month, groceries pushing past $1,200 for a modest household. These numbers are felt more clearly than any speech or statistic. They bypass ideology and hit routine. This is why trust erodes faster during price shocks than during recessions. Job losses are episodic. Price increases are permanent. When wages stagnate but bills reset upward, people stop believing explanations. Official narratives lose power when receipts contradict them. Confidence does not decline gradually, it snaps. The pressure reshapes public behavior. Consumption narrows to essentials. Discretionary sectors weaken. Small shocks trigger outsized reactions. A new fee sparks outrage not because of its size, but because it lands on a system already at capacity. When households operate with no margin, tolerance disappears. Governments struggle here because price stress ignores messaging. Rate cuts don't lower grocery bills. Subsidies don't fix insurance resets. Temporary relief does not reverse permanent repricing. Each intervention feels smaller than the problem it's meant to solve, widening the credibility gap. What emerges is not rebellion, but withdrawal. People disengage from institutions that no longer seem responsive. Civic participation declines. Social cohesion thins. The economy becomes brittle, still functioning, but without trust holding it together. This is the breakpoint. Not when people can't afford luxuries, but when they question the value of participation itself. When working, paying, and complying no longer promise stability, the system loses consent. No policy announcement can restore that once it's gone. Prices don't just measure inflation, they measure legitimacy. And when the cost of basic life keeps rising while income and relief stall, the final message isn't spoken. It's priced in. Because a system that must be financed with debt, endured with silence, and justified with excuses has already crossed the line. And prices are still climbing.